If you have ever entered a trade that looked perfect, only to get stopped out before price moved exactly where you expected, this video is for you, because the market did not trick you. You were simply looking at the chart without understanding the full story behind price. Welcome back. In this video, I'm going to break down a real market scenario step by step and show you how smart money builds a bullish move, where liquidity is taken, why structure breaks when it does, and how entries, stop loss, and targets are designed with precision, not guesswork. By the end of this video, you will clearly understand how to identify a bullish market structure, how sell-side liquidity is collected, why the break of structure matters, what happens above price that forces continuation, how order blocks are formed, why sell-side liquidity behind the order block exists, and how to execute a clean trade with defined risk and logical targets. This is not a signal. This is education. Now let's begin from the left side of the chart, because everything starts with structure. At the beginning, the market is clearly bullish. We are forming higher highs and higher lows, which tells us buyers are in control. Price is respecting structure, pullbacks are shallow, and every correction is being bought aggressively. This is important because structure tells us intent. When the market is bullish, smart money is not looking to sell the top. They are looking to accumulate positions and engineer liquidity to continue higher. As price moves forward, we notice something very deliberate. The market pushes lower and takes out an obvious low. This is not a trend change. This is a liquidity grab. Below that low sits sell-side liquidity, the stop losses of traders who bought earlier and placed their stops in predictable locations. Smart money needs that liquidity. Without liquidity, large positions cannot be filled efficiently, so price dips lower, triggers those stops, and absorbs the sell orders. To retail traders, this looks like weakness. To institutions, this is opportunity. Immediately after sell-side liquidity is collected, price reacts strongly. This reaction is the first clue that the move down was not genuine selling pressure. It was engineered. Now comes one of the most important moments on the chart. Price rallies and breaks above a previous high with strength. This is a clear break of structure, not a wick, not a slow grind, a decisive displacement. This break of structure confirms that the bullish trend is still intact and that the liquidity grab served its purpose. Smart money has filled positions. Now the market is ready to move. But before price can expand higher, something else must happen. Look above the current price. What do you see? You see equal highs. You see short-term resistance. You see buy stops resting above those highs. That is buy-side liquidity. Those highs represent the stop losses of sellers and the breakout entries of late buyers. Liquidity is sitting there, waiting to be taken. Markets do not move randomly toward targets. They move toward liquidity. Now watch what happens next. Price pulls back after the break of structure. This pullback is not weakness. This is preparation. Price retraces into a bullish order block. This order block is formed from the last bearish candles before the strong bullish displacement. That is where institutions previously placed large buy orders. And because price left this area aggressively, we know not all orders were filled. This order block now becomes a zone of interest. But here is where most traders make a critical mistake. They buy the order block blindly. Smart money does not enter blindly. They wait for confirmation and liquidity. And this brings us to what happens behind the order block. Below the order block sits sell-side liquidity. This liquidity exists for a reason. It is the fuel for the next move. Price often dips into or just below the order block to trigger stops of early buyers. This creates additional sell orders that institutions can absorb. This is why sell-side liquidity behind the order block is so important. It allows smart money to add to positions at optimal prices, while weak hands are forced out. Now let's talk about the entry. The entry is taken after price taps into sell-side liquidity and shows clear rejection. This rejection confirms that smart money has finished accumulating. We do not enter on hope, we enter on confirmation. The stop loss is placed slightly below the last swing low, not exactly at the low, slightly below it. Why? Because stops are liquidity, and placing your stop exactly where everyone else does is asking to be taken out. By placing the stop just beyond the low, we protect the trade while allowing the market to breathe. Now the target. The target is not random, the target is buy-side liquidity. Above price, we already identified equal highs and resting buy stops. That is where the market wants to go. Liquidity is the objective. So our trade aligns perfectly with the algorithm. We enter after sell-side liquidity is taken. We protect ourselves beyond invalidation. And we target buy-side liquidity. This creates a clean, logical, high-probability setup with favorable risk to reward. No indicators, no guessing, no emotions, just structure, liquidity, and execution. This is how smart money trades, and this is how you stop reacting to the market and start understanding it. If this breakdown helped you see the chart differently, make sure you are subscribed. In the next video, we will go deeper into execution models, entry confirmations, and how to refine precision even further. This is not a signal. This is education. Trade responsibly.